what you'll see on the credit report, the first part of your credit report contains your personal information. Name, social security number, sometimes date of birth, your address. One of the things that the banks are looking for is, do the addresses match up? Are the addresses matching what you have in your personal financial statement? Do the addresses match what you've had historically? Employment information, the banks generally aren't, when you're looking for a business loan, they generally aren't really looking at the employment information line, because oftentimes it's not going to say too much if you're self-employed, other than you're self-employed. But they might look at the type of employers that you've had before, and they might look at, you know, what type of industries you've been in as far as experience level. Okay, the report summary is basically the history of how you make your payments. You're going to see on the far right, typically, you'll see a track history where it talks 30, 60, or 90 days. That's 30 stands for 1 month behind, 60 is 2 months, and 90, of course, is 3 months. And basically what that's doing is, if you see a series of ones going across, it means you're current each month. As you get into the twos, that means at some point you missed a payment, you were down by a month, you were down by 30 days. And now it's reporting that. And usually the reports will report the particular date that it reported that 30-day activity. So it'll tell you what month that was. Public records you'll also find in this section. Those public records are going to include bankruptcies, judgments, collection actions, sometimes foreclosures, sometimes not, depending upon the area that you live in. Most of the time in our area, the foreclosures are reported actually on the mortgage line, and that just happens to be because of where we live. It's different in a lot of different states. One of the things that I like to point out on the scorecard is your available credit percentage. For me, that's an important measure of your capacity. The more credit available that you have, the more positive it is. It's best for you to come to apply for a loan, especially with a startup, when that credit availability is close to 100%. And the reason being is if you needed funds in a hurry to help make a shortfall, you know, and I need money next week, a lot of times your credit cards are there to bail you out, and they're some of the best source of funding to get a small company going. All right, to define the percentage, and different credit bureaus show different ways. Some show available credit, they'll show the percentage, and that means if you have one credit card with a $10,000 limit and you owe $2,000, you have 80% available. Some show a utilization percentage, which would be the opposite. They'll say you have 20% used. What we care is that the available credit, or the unused portion, is as big as possible. One of the things you'll also find from a consumer standpoint is having that available, you'll see that having over 50% utilization actually becomes a negative and hurts your credit score and causes your credit score to drop. That's probably the most significant indicator as far as where credit scores are at. For example, if you have a $10,000 credit limit and you have a balance that's $5,001, which is just over half, all of a sudden that starts to limit your credit score, and your credit score starts to drop. As you use those limits up and you start getting, your balance becomes $9,000, you're getting very close to that $10,000, your score has probably dropped very significantly. Or public records section, collections, judgments, etc. What the lenders are going to care about is that it shows status paid and there isn't really an outstanding balance. Oftentimes they may ask you what caused the collection, how did it happen, and they're looking there at that point for your story. The story is really for documentation purposes, so we can kind of explain away what happened. But for the most part, what we care about is that the balances are zero. After they're at zero, you may not get asked about the situation again. The last item that's always on everybody's credit report is the inquiry section. The inquiry section basically just tells you who's pulled your credit report. Every time your credit is pulled, your score drops a little bit. Depending upon who the industry is, it makes a difference as far as how far the score drops. If you're going to a high-risk company that does loans for people with poor credit, bankruptcies, etc., they're going to have a huge negative impact on the score. Banks generally don't have a significant impact, usually about 8 to 10 points. So if your score was 760, it'll be 752 the next day if somebody else were to pull the bureau because the bank had pulled it. And that would only change if you went to another creditor. As long as you stayed with the same bank, your score wouldn't change, no matter how many times they pulled your credit. The most significant company that will ever pull a bureau on you is a mortgage company. It's very common for a 30-point drop in your score, and a 50-point drop is not uncommon when you apply for a mortgage. A mortgage is the most severe transaction a consumer can do, so when you apply for a mortgage, just kind of be careful. It's not wise to shop around to 3 different mortgage companies and have them pull bureaus on you. It's more wise to shop around, ask for what the rates are, find one that you like the loan officer, find one you're comfortable with, see if you can get approved through them first before you apply with somebody else, so that not every mortgage company out there is pulling your credit bureau.